Assalamu alaikum and good day everyone. We are the team Dauntless, and for this video lecture we're going to discuss the first chapter, which is about auditing and internal control. And I am Nurhana Abubakar to start off the discussion. Now this chapter provides an overview of IT auditing. We begin by describing the various types of audits that organizations commission and distinguish between the auditor's traditional attestation responsibility and the emerging field of advisory services. And then the role of the audit committee, the financial audit components will also be discussed, as well as the components of audit risks. And then we go on to explain the structure of an IT audit, the relationship between management assertion, audit objectives, test of controls, and substantive tests are also be explained. Then, the chapter also explains the key points of the COSO control framework, which defines internal controls in both manual and IT environments. And then the final section of the chapter examines audit issues and implications related to Sarbanes-Oxley legislation and provides a conceptual framework that links general controls, application controls, and financial data integrity. And for this particular chapter, it will highlight, but of course, it is not limited to these key terms, and somehow some of these terms are already familiar to us since we encountered them in our previous subjects. And after learning this chapter, we are expected to know the difference between attest services and advisory services and be able to explain the relationship between the two, understand the structure of an audit, and have a firm grasp of the conceptual elements of the audit process, understand internal control categories presented in the COSO framework, be familiar with the key features of Section 302 and 404 of the Sarbanes-Oxley Act, and then understand the relationship between general controls, application controls, and the financial data integrity. Now, in today's fast-evolving digital era, business organizations are now emerging. With internet and digitalization, the organizations are also coping up with the challenges that this period brings. The financial reporting needed by investors and shareholders are changing, the execution of audits are also being transformed, and then recent developments in information technology, or the what we call IT, have had a tremendous impact on the field of auditing. Because of IT, our business operations are now more efficient, and the communications within the entity and between the entity and its customers and suppliers improved. However, these advances have introduced new risks that require unique internal controls. They are now in need for new techniques for evaluating controls and for assuring the security and accuracy of corporate data and the information systems that produce it. Now, let's delve deeper with auditing by first understanding the different types of audit. We all know that business organizations undergo different types of audits for different purposes. And the most common of these types of audits are external, or the what we call financial audit, internal audit, and then fraud audit. Now let's first discuss the external or the financial audit. So external audit is an independent attestation performed by an expert. Who is this expert? The auditor, who expresses an opinion regarding the presentation of financial statements. And this task is also known as the attest service. It is performed by CPA, the certified public accountants who work for public accounting firms that are independent of the client organization being audited. Now, let me give an illustration how this service works. Now let's say ABC Corporation prepares annual financial statements for its investors, creditors, the government, and other users. Then these users have doubts as to whether the statements will meet their need for fairly stated information. Now, by engaging the services of an independent CPA, the statements will be audited and then checked against the generally accepted accounting principles, or the GAAP, and then a report signed by that CPA will be attached to these statements, and then the users will rely on that audited financial statements because these statements have credibility, they can be relied upon, and they are fairly presented. So this is how the attest services works. The audit objective is always associated with assuring the fair presentation of the FS. That's why they often referred to as financial audits. Now, the Securities and Exchange Commission requires all publicly traded companies be subject to a financial audit annually. Remember? The key concept in this process is independence. The external auditor must remain independent, and that independent auditor collects and evaluates evidence and renders an opinion based on that evidence. So, the external auditor must follow strict rules in conducting financial audits, and these authoritative rules have been defined by the Securities and Exchange Commission, the Financial Accounting Standards Board, the AICPA, and by federal law, which is the Sarbanes-Oxley or the SOX Act of 2002. So what is this Sarbanes-Oxley Act of 2002? It is actually a federal law that established sweeping, auditing, and financial regulations for public companies. Lawmakers created this legislation to help protect shareholders, employees, and the public from accounting errors and fraudulent financial practices. Now, aside from attest services, many public accounting firms also offer advisory services. So what's the difference between these two? Now, when we say attest service, as we illustrated a while ago, it is an engagement in which a practitioner is engaged to issue or does issue a written communication that expresses a conclusion about the reliability of a written assertion that is the responsibility of another party. And the following requirements apply to attestation services. First, attestation service requires written assertions and a practitioner's written report. Second, attestation service requires formal establishment of measurement criteria or their description in the presentation. And last, we have the levels of services in attestation engagements are limited to examination, review, and application of agreed upon procedures. Now, let's take a look at the advisory service. Now, in here, advisory services are professional services offered by public accounting firms to improve, take note, their client organization's operational efficiency and effectiveness. Like for example, from the word itself, advisory services, we have actuarial advice, business advice, fraud investigation services, information system design and implementation, and internal control assessments for compliance with SOX. So before the implementation of SOX Act, accounting firms can provide advisory services. At the same time, they can provide audit to clients or for clients. However, after that implementation of the Act, it is now unlawful for a registered public accounting firm that is currently providing attest services for a client to provide the following services. We have bookkeeping or other services related to the accounting records, financial information systems design and implementation, appraisal or valuation services, fairness opinions or contribution in kind reports, actuarial services, internal audit outsourcing services, management functions or human resources, broker or dealer, investment advisor or investment banking services, legal services, and expert services unrelated to the audit, and any other services that the board determines by regulation is impermissible. So meaning, if you are, let's say, auditing an FS for a client, you can't provide those mentioned services at the same time under Sarbanes-Oxley or the SOX Act of 2002. Advisory services that are responsible for providing IT control-related client support all engage in tasks known as the IT risk management. And these groups play a dual role. In what way? They provide non-audit clients with IT advisory services, and also they work with their firm's financial audit staff to perform IT-related tasks of controls as part of the attestation function. Now moving on, the next type of audit we have internal audit. The Institute of Internal Auditors, or the IIA, defines internal auditing as an independent appraisal function established within an organization to examine and evaluate its activities as a service to the organization. Now, internal auditors actually perform a wide range of activities as compared to external on behalf of the organization, including examining an operations compliance with organizational policies, reviewing the organization's compliance with legal obligations, and the likes. So internal auditors are often certified as a certified internal auditor or a certified information systems auditor. They also remain objective and independent, just like external auditor, to perform their duties effectively. They represent the interests of the organization as compared to external. Sa external, they represent outsiders. So in here, the standards, guidance, and certification of internal audits are governed mostly by the Institute of Internal Auditors, the IIA, and to a lesser degree by the Information Systems Audit and Control Association, or the ISACA. Now, let's differentiate more about the internal auditor from external auditor. So the most familiar distinction between the two is that external is someone outside the company or the organization, while an internal auditor is someone inside the company. But first, let's take a look at the similarities between the two. First, both external and internal follows a systematic approach. Both internal and external also are objective processes, meaning both auditors possess independence and objectivity. Next, they also involve obtaining of evidence in order to support the conclusion in obtaining auditor's report. Next, even in internal audit, we have assertions and criteria. And lastly, they both include communication of results to users, which also means even in internal audit, we also have an audit report. However, despite these similarities, differences also exist between the two. First, in terms of relationship of the auditor to the organization under audit. The external auditor is not an employee of the auditee, as we also illustrated a while ago, meaning an organization engages a totally independent company to perform audit services for them. For example, an organization is contracting to another company. That is completely different. Now, an internal auditor is an employee of the auditee. However, although they are employees of the organization, they are required to remain objective and independent through duality of reporting. What does this mean? Though internal auditor administratively reporting to the management of an organization, they are functionally reporting to the audit committee of the board of directors. So, independence and objectivity is still maintained in an internal auditor. Next, in terms of scope and objectives. So based on the definition of the two, an external auditor is focused on financial statements and provide unbiased opinion as to the fairness of the presentation of the FS or the financial statement. For internal, we are into governance, risk management, and controls. And as I've said a while ago, the internal auditor covers a wide range of activities in the organization, not limited only to financial reporting. Next, for governing or authoritative body, the one who will issue authoritative standard and guidance. For external, since we pertains to the audit of FS, we have the BOA for that under the Professional Regulatory Commission. Moreover, to assist the BOA in establishing and promulgating auditing standard in the Philippines, we have the AASC, the Auditing and Assurance Standards Council. They establish and issue the Generally Accepted Accounting Standard. Meanwhile, internal audit is governed by international organization called Institute of Internal Auditors. Lastly, based on certification required. So, an external auditor must be a CPA. However, an internal auditor is not necessarily a CPA. Remember, these are just some of the differences between the external auditor and internal auditor. Nevertheless, internal auditors and external auditors often work together. Internal auditors cooperate with and assist external auditors in performing aspects of financial audits to achieve audit efficiency and reduce audit fees. For example, a team of internal auditors can perform tests of computer controls under the supervision of a single external auditor. Another example is that internal auditors can gather audit evidence throughout a fiscal period, which external auditors may then use at the end of the year to conduct more efficient, less disruptive, and less costly audits of the organization's financial statements. Now down to the last type of audit, we have broad audit. So It is a detailed examination of the financial records of a business with the intent of finding instances of fraud. So we all know in recent years, fraud audits have unfortunately increased in popularity as a corporate governance tool. And the objective of a fraud audit is to investigate anomalies and gather evidence of fraud that may lead to criminal conviction. Sometimes, fraud audits are initiated by corporate management who suspect employee fraud. So, boards of directors may hire fraud auditors to look into their own executives if theft of assets or financial fraud is suspected. So organizations victimized by fraud usually contract with specialized fraud audits of public accounting firms or with companies that specialize in forensic accounting. So typically, fraud auditors have earned the Certified Fraud Examiner certification, which is governed by the Association of Certified Fraud Examiners. Now, let us know the role of the Audit Committee. The Board of Directors of publicly traded companies form a subcommittee known as the Audit Committee, which has a special responsibilities regarding audits. So this committee usually consists of 3 people who should be outsiders. Now, with the advent of the Sarbanes-Oxley Act, at least one member of the Audit Committee must be a financial expert. And this Audit Committee serves as an independent check and balance for the internal audit function and binds or works together with external auditors. And one of the most significant changes imposed by the SOX Act has been to the relationship between the management and the external auditors, because before, external auditors were hired and fired by the management. But then, many believe that this relationship erodes auditor independence when disputes over audit practices arise. So, SOX mandates that external auditors now report to the Auditor Committee who hire and fire auditors and resolve disputes. So, to be effective, the Auditor Committee must be willing to challenge the internal auditors as well as the management when necessary. So, part of its role is to look for ways to identify risk. Also, corporate frauds often have some bearing on audit committee failures, such as lack of independence of audit committee members, inactive audit committees, total absence of an audit committee, and lack of experienced members on the audit committee. Now, let's answer these learning checkpoints. First, which of the following types of auditing is performed by CPAs on a contractual basis? A. Internal audit, B. External audit, C. Fraud audit, and letter D. Government audit. And the answer is letter B, external audit, because remember, on a contractual basis. Next, SOX or the Sarbanes-Oxley Act of 2002 mandates that external auditors now report to the management who hire and fire auditors and resolve disputes. Is it true or false? So the answer is false, because this statement must be SOX mandates that external auditors now report to the Audit Committee, and it is not the management anymore who will hire and fire auditors and resolve disputes. So it is management if prior SOX. So that's it.